What happens when auditors don't do their jobs? You get billions of dollars of fraud and people's entire life savings disappear in an instant. That's why the auditor's dilemma is so important. They must be objective and independent when they're doing their job. Except the problem is, the same people that they're investigating are the ones writing their paycheck. To understand the consequences of the auditor's dilemma in the real world, we're gonna go over 3 of the craziest fraud cases in US history, with each one getting bigger than the last. And with each fraud, we're gonna focus on what the auditors did, because their actions had the chance to change everything. But in the case of Tyco, the auditors involved did absolutely nothing. And it makes sense why they didn't. The auditing company was getting paid $13 million for their services. That same company, PricewaterhouseCoopers, was getting $50 million a year from Tyco for other accounting services. The man behind it all was Richard Scalzo, the lead audit partner from PwC. This is the guy who signs off on all of the audits for Tyco. Scalzo was saying that everything was normal, when really, Tyco's CEO and CFO took $600 million from the company over the course of 6 years. These two used company funds to pay for their absurd lifestyles. We're talking $2 million for the CEO's birthday party, $30 million for a luxury Manhattan penthouse with $6,000 curtains for each of the windows, and art pieces worth tens of millions. And all of these things were being listed as business expenses on Tyco's accounts, as loans, employee bonuses, and more. The Tyco executives worked together to falsify the company's records and used their power to approve the fake expenses. This strategy might have gone on forever, but the feds happened to get the CEO for tax evasion, and in their investigation, the fraud completely unraveled. According to those federal investigators, Richard Scalzo acted recklessly in his auditing work. While Tyco's CEO did a good job of covering up the ongoing fraud, there were obvious red flags. But instead of digging deeper into the situation, Richard Scalzo let it go, and that's the problem. In this case, Scalzo and PwC had every incentive not to dig deeper. Why jeopardize a $50 million client? The thing to remember is that Tyco didn't get away with this fraud because it was complicated or anything. It was really simple. The people in charge abused their power and internal controls failed. So all it took was PwC picking the wrong side of the auditor's dilemma to let this happen. The result was that the CEO and CFO were convicted and sentenced to 8 to 25 years in prison, and the auditor was banned from any financial work forever. And Tyco was forced to pay $3 billion to investors who sued them after their stock tanked. That might seem like an insane fraud, but the case of Enron blows Tyco out of the water. Enron started as a natural gas company in 1985, but under Kenneth Lay and Jeffrey Skilling, it rebranded itself as an energy trading company. Inexplicably, by the year 2000, Enron stock had hit $90 a share. On paper, Enron seemed unstoppable, but that growth wasn't real. It was a cover-up for mass fraud. Enron's entire operation relied on 2 accounting tricks. First, they used mark-to-market accounting. Instead of waiting to earn revenue, Enron marked projected future profits immediately. It went like this. Say they made a deal worth $10 million with someone that had the potential to earn $30 million if things went really well. Well, instead of telling the truth and writing down the actual income of $10 million, Enron just put $30 million in there instead, and wrote that down as current income. And if the deal failed later, they didn't even take the loss. Then they used special purpose entities, which are basically shell companies. Led by CFO Andrew Fastow, Enron created hundreds of off-the-books companies to hide Enron's debt and failing assets. So while investors were seeing high profits and an absurdly strong balance sheet, Enron was actually dealing with massive debt and failing projects behind the scenes. And just like Tyco, the auditors were right there the whole time. Arthur Andersen was supposed to be looking at Enron's books. They were one of the biggest accounting firms in the world, and yet they didn't just miss the fraud. Just like Richard Scalzo in the Tyco situation, the auditors representing the Arthur firm not only failed to investigate obvious red flags, they also aided Enron in making these fraudulent shell companies to look legit. This was an obvious abuse of the generally accepted accounting principles. And when the government started to investigate Enron for their shady activity, the auditors were found guilty of obstructing justice for destroying Enron's audit documents, just to cover their own tracks. And you want to know why they did that? In the year 2000 alone, Arthur Andersen made $25 million from just its auditing services, not to mention $52 million in total revenue from their client, Enron. Yeah, that's definitely not a conflict of interest at all. By the time the US Securities and Exchange Commission had finished its investigation, Enron had admitted it had inflated inflated profits by nearly $600 million. Its executives got over a decade in prison. Innocent employees and thousands of investors lost their entire retirement savings that were tied up in Enron stock. At the time, Enron was one of the largest cases of fraud in U.S. history, all because of bad accounting and some complicit auditors. But you know someone else had to try and beat that record. What happens when one company lies so well that it becomes the biggest accounting fraud in U.S. history? Because that's exactly what happened with WorldCom. By the early 2000s, WorldCom wasn't just another telecommunications company. It was an industry giant. They had tons of revenue coming in, and with that came huge market expectations. The CEO, Bernard Ebbers, was under constant pressure to keep the stock price climbing and keep shareholders happy. You can see where this is going. WorldCom took billions of dollars in everyday operating expenses, specifically line costs, and instead of recording them as expenses, they marked them as capital. And why does that matter, you might ask? Because it was artificially boosting WorldCom's value while simultaneously reducing expenses, making their balances look absurdly good. And that made their stock price skyrocket. And of course, WorldCom executives were directly involved in manipulating the numbers. There's also strong evidence that Bernard Ebbers knew what was going on too, because his personal wealth and status as one of the highest paid executives in the country depended on the company's fraudulent growth. Once again, external auditors failed to discover the fraud. They were paid as much as $15 million a year for their services. It was actually WorldCom's internal auditors that chose the right side of the auditor's dilemma in this case, which is crazy considering they were working against their own employer. They had every reason not to investigate their bosses. WorldCom's auditors started digging into those capital expenditures, even though executives pushed back as hard as they could. These auditors were forced to work secretly at night to avoid scrutiny from their higher-ups, just to get to the bottom of the weird accounting entries. Eventually, they connected the dots, which caused WorldCom's controller, David Myers, to admit that he was fudging the numbers. WorldCom had overstated their earnings report by $11 billion, just to make themselves look good for shareholders and hide their declining profits. But when they do them right, you get the collapse of these fraudulent companies.